Let's be honest for a moment. You hear the word investing, and your stomach tightens just a little bit. Your mind might immediately jump to images you've seen in movies. People in suits yelling on a trading floor, complicated charts with flashing red and green lines, or news headlines screaming about a market crash. You think about the stories you might have heard, maybe even from family or friends, about people who lost a lot of money overnight. You've worked hard for your money. Every dollar represents your time, your energy, and your effort. The idea of putting that hard-earned money into something where it could just disappear, it's not just a little scary, it's terrifying. It makes perfect sense that you might feel safest with your money sitting right where you can see it and understand it, in a regular savings account at your bank. I want you to know that you are not alone in feeling this way. In fact, that fear is completely normal and logical. It's a sign that you are responsible and careful with what you have. But here is the difficult truth, the one that nobody really likes to talk about. What if I told you that the safest option, just letting your money sit in a savings account, is actually a guaranteed way to lose its value over time? This video is for you. It's for every single person who wants to build a better, more secure financial future but feels paralyzed by the fear of making a costly mistake. I promise you, we are not going to talk about risky strategies, picking individual stocks, trying to get rich quick with crypto, or any other complicated method to time the market. That's not for beginners, and honestly, it's not for most experts either. Instead, over the next 30 to 40 minutes, I am going to give you a simple, clear, step-by-step blueprint. It's a plan designed specifically for the cautious beginner. We are going to take that fear you feel, acknowledge it, and then we are going to transform it into a clear, actionable plan that puts you, not your emotions, in control. Here's our roadmap for this journey. First, and most importantly, we're going to work on a complete mindset shift. We'll change the way you think about risk, saving, and your money's future. Second, we'll break down the absolute, must-know basics of investing, but we'll use simple, everyday analogies so it all makes sense. Forget the confusing jargon. Third, I will reveal the single best and most recommended strategy for cautious beginners, a powerful method that actually benefits from the market's inevitable ups and downs. It turns a scary thing into a helpful thing. Fourth, we are going to get practical. We will walk through the exact, literal steps to get started, from choosing and opening an account to making your very first investment. And finally, we will circle back and tackle the big one: how to handle your emotions and what to do when the market inevitably panics. Because it will. By the end of this video, my goal is that you won't just understand investing. You'll have a concrete plan to do it confidently and, most importantly, sleep well at night. So let's start with that mindset shift. Why can't we just keep our money in a savings account? It feels safe. It's insured. What's the problem? The problem has a simple name: inflation. Inflation is the silent thief. It's the reason that a candy bar that cost 25 cents when your parents were kids now costs $2. It's the reason a movie ticket that cost $5 in the year 2000 now costs $12, $15, or even more. The price of almost everything we need to live, from our groceries and our gas to our rent and healthcare, is constantly, slowly, and surely going up. Now, think about your savings account. What kind of interest rate does it pay? Maybe you get 0.5%, or if you're lucky, 1 or 2% per year. But if the cost of living, which is what inflation measures, is rising by 3% or 4% per year, what is actually happening to your money? Even though the dollar amount in your account is staying the same or going up by a tiny bit, its ability to buy things in the real world is going down. Your money is losing its power. Every day? Every month. Every year that your money sits in a low-interest savings account, it can buy you less and less. Keeping your money safe in cash is like trying to hold water in a leaky bucket. You don't see the loss dramatically overnight, but you look down the road 5 or 10 years from now, and you realize a lot of its value has slowly leaked away. That is a guaranteed loss. Now for the good news. While inflation is a powerful force working against you, there is an even more powerful force that can work for you. It's been called the eighth wonder of the world. It's called compound interest, or compounding growth. Here's what it means in simple terms. It's your money making money. And then the money that your money made starts making more money. It creates a snowball effect that starts small but can grow into something enormous over time. Let me give you a very simple example. Imagine you have $1,000. If you put it in a shoebox, in 20 years, you will still have exactly $1,000. But if you invest it and it earns an average of 7% per year, after the first year, you'd have $1,070. You made $70. Not bad. But the magic happens in year two. You don't just earn 7% on your original $1,000 anymore. Now, you earn 7% on the new total of $1,070, so you make about $75. In year three, you earn interest on top of that new, bigger amount. It doesn't sound like much at first, but over 20 or 30 years, this effect becomes incredibly powerful. That initial $1,000, without you adding another penny, could grow to over $3,800 in 20 years, or over $7,600 in 30 years. Just from this compounding effect, investing is the engine that allows your money to grow faster than the rate of inflation. It's how you turn that leaky bucket into a fountain, building real, long-term wealth that can secure your future. So with that in mind, we need to redefine what risk really means. Is the real risk a temporary 20% drop in the value of your investments, which has historically always recovered over time? Or is the real risk working your entire life, saving diligently, only to reach retirement and find out that your savings can't cover your basic living expenses because inflation ate it all away? The goal of investing for a beginner isn't to become a millionaire overnight or to avoid all the bumps in the road. The goal is simply to ensure your money grows enough to give you choices and security in the future. Okay, so hopefully you're starting to see why investing is so important. Now let's talk about the what. What are we actually buying? Let's demystify the jargon with some simple analogies. First up, you have stocks. A stock, which is also called a share or an equity, is simply a tiny piece of ownership in a single company. When you buy one share of Apple stock, you literally own a tiny, tiny fraction of the whole company. You own a piece of every iPhone, every MacBook, and every App Store transaction. If Apple as a company does really well, makes a lot of profit, and people are excited about its future, the value of your tiny piece goes up. If the company makes a bad decision or has a bad year, the value of your piece can go down. The potential for growth with stocks can be very high. If you had bought a piece of a small company that grew into a giant, you could have made a lot of money. But here is the problem. Especially for beginners, trying to pick which single company will be the next big winner is incredibly difficult and very risky. For every success story like Apple or Amazon, there are thousands of companies that have failed. Putting all your money into one or two stocks is like betting all your money on a single horse to win a race. If that horse stumbles, you lose. Next, let's talk about bonds. Bonds are much simpler and are generally much safer. A bond is basically just a loan. You are lending your money to a big organization, usually a government or a very large, stable corporation. In return for your loan, they promise two things. First, they will pay you back the full amount of your original loan after a set amount of time, like 5, 10, or 30 years. Second, along the way, they will make regular interest payments to you, kind of like the interest you get from a savings account, but usually a bit higher. Because you are just making a loan to a very reliable borrower, the risk of losing your original money is very low, especially with government bonds. They are the predictable, safer cousin to stocks. However, because they are safer, the potential for growth is also much, much lower. Bonds are great for preserving your money, but they usually won't grow it fast enough to beat inflation by a large amount. So, stocks can be too risky if you only pick one or two. Bonds are safe, but maybe a little too slow. So what's the solution for a beginner who wants growth but is scared of the risk? This brings us to the single most important concept for you to understand in this entire video. This is the beginner's best friend. It's the idea of an index fund or an ETF, which stands for Exchange Traded Fund. Let me ask you a question. What if, instead of trying to pick the one winning horse in a race, you could make a single bet that paid you if any of the top horses did well? What if you could buy one single thing that instantly gave you a tiny piece of ownership in hundreds, or even thousands, of the biggest and best companies all at the same time? That is exactly what an index fund or an ETF does. Think of it like going to a grocery store. Buying a single stock is like buying one single apple. If that apple turns out to be rotten, you've wasted your money. But an index fund is like buying a pre-made fruit salad. In one container, you get a small piece of an apple, a slice of an orange, a few grapes, a piece of a banana, and a strawberry. If the apple happens to be a little bruised, it doesn't matter that much, because the rest of the fruit is still good. You've spread out your risk. In the investing world, this is called diversification, and it is the key to reducing risk. An S&P 500 index fund, for example, is a very popular type of fund. When you buy just one share of it, you are instantly buying a tiny piece of the 500 largest and most successful companies in the United States. You get a piece of Apple, Microsoft, Amazon, Google, Johnson & Johnson, Walmart, and 494 others, all in one simple transaction. If one of those companies has a terrible year, it has a very small impact on your total investment because it's balanced out by the other 499 companies that are likely doing just fine. This is the secret. It removes the impossible pressure of having to be a genius stock picker. You're no longer betting on a single company, you are betting on the long-term success of the entire U.S. economy as a whole. And historically, for over a century, that has been a very, very good bet. This is the cornerstone of our strategy for the scared investor. It gives you the growth potential of stocks, but with dramatically reduced risk thanks to instant diversification. So, now you know the why to beat inflation and build wealth, and you know the what to focus on diversified index funds. Now we get to the heart of it, the how. This is our simple three-pillar strategy designed to let you invest successfully while keeping your fear under control. Let's call it the I'm still scared strategy. Pillar number 1 is to embrace broad market, low-cost index fund ETFs. Let's break that down. Broad market just means it covers a very large part of the stock market, like we discussed. Low cost is extremely important. All funds have a small yearly fee, called an expense ratio. Your job is to choose funds with the absolute lowest fees possible. We are talking about fees as low as 0.03% or 0.04% per year. High fees can eat away at your returns over time, so always look for low-cost options. Reputable companies like Vanguard, Fidelity, and Charles Schwab are famous for these. So, what are some real-world examples you can look up? A very common one is an ETF with the ticker symbol VTI. This is Vanguard's Total Stock Market ETF. It holds a small piece of nearly every single publicly traded company in the entire United States. Over 3,000 of them. Another extremely popular one is VOO. This is Vanguard's S&P 500 ETF, which tracks those 500 largest U.S. companies. By buying just one of these, you are not gambling. You are making a calculated, long-term investment in the overall growth of American business. It's the most simple, effective, and recommended approach for beginners. Now for pillar number 2, and this is the secret weapon that is going to completely kill your fear of investing at the wrong time. It's called dollar cost averaging, or DCA for short. This might sound complicated, but the concept is incredibly simple and powerful. Dollar cost averaging just means you invest the exact same amount of money at regular, scheduled intervals, no matter what the stock market is doing. For example, you decide you can comfortably invest $100 every month. You set it up so that on the first day of every single month, your account automatically invests $100. That's it. That's the whole strategy. Here is why this is pure magic for a fearful investor. Let's say in January, the price of your chosen index fund, let's call it VOO, is $100 per share. Your automatic $100 investment buys you exactly one share. Easy. In February, the market is doing well and the price goes up to $125 per share. Your automatic $100 investment now only buys you 0.8 shares. That's okay. But in March, the news is terrible. There's a panic, and the market drops. The price of VOO falls all the way down to $50 per share. Your stomach might drop with it. This is the moment when fear tells you to run away. But what does your automatic plan do? Your same $100 investment, without you lifting a finger, now automatically buys you 2 full shares. Do you see what just happened? When the market is high and prices are expensive, you naturally buy less. But when the market is down, when things are scary and prices are cheap, your strategy automatically makes you buy more. You are buying on sale, and you don't have to make an emotional decision to do it. This completely removes the impossible burden of trying to time the market. Nobody, not even the experts, can perfectly predict when the best day to invest is. With dollar cost averaging, you don't have to guess. You just buy consistently, month in and month out. Over the long run, this strategy smooths out all the bumps of the market and lowers your average cost for each share you own. It is the most powerful antidote to making emotional, fear-based decisions. And that leads us directly to pillar number 3, automate. 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 The single biggest enemy of a long-term investor is their own brain. We are wired to be emotional. When things are good, we get greedy. When things are bad, we get scared. The key to success is to take your emotions out of the process as much as possible. The best way to do this is to put your entire investment plan on autopilot. Think of it as set it and forget it. Picola. Every single major brokerage firm allows you to set up automatic transfers from your bank account to your investment account, and then set up automatic investments into the fund of your choice on a specific schedule. You can set it up to invest $50 every Friday, or $200 on the 15th of every month. Once it's set up, the system works for you in the background. The money moves, the investments happen, and your wealth slowly builds, all while you are living your life. You don't have to log in. You don't have to look at the market. You don't have to make a decision every month. This automation is the final piece of the puzzle that protects you from your own worst enemy, your own fear and greed. Okay, so we have our strategy. But where do you actually do all of this? This brings us to the practical action plan. We'll get you from zero to invested in 3 simple, non-scary steps. Step 1 is to choose your home, which means opening an account with a brokerage firm. A brokerage is just like a bank, but it's designed to hold investments instead of just cash. For absolute beginners in the United States, I strongly recommend you start with one of the big, reputable, and low-cost firms. The top 3 are generally considered to be Vanguard, Fidelity, and Charles Schwab. All of them are excellent, have great customer service, and offer a wide range of low-cost index funds and ETFs. You can't go wrong with any of them. When you go to their website to open an account, you will see a few different options. For now, let's focus on just 2. The first is a standard, taxable brokerage account. It's a basic account that lets you buy and sell investments. The second, and often a much better choice for long-term beginners, is a Roth IRA. An IRA is an individual retirement account. Think of it as a special investment account with amazing tax benefits designed to help you save for retirement. With a Roth IRA, you put money in that you've already paid taxes on. But here is the incredible part. All of that money, including all the growth and compound interest it earns over decades, can be withdrawn in retirement completely, 100% tax-free. This is one of the best deals the government offers to savers and investors. If you are eligible to contribute to a Roth IRA, it is often the best place to start your investing journey. Step 2 is to simply open the account. I promise you, this is easier than you think. The entire process can be done online from your couch in about 15 minutes. It's very similar to opening a new online bank account. You'll go to the website of Vanguard, Fidelity, or Schwab, and you'll click Open an Account. You will need to provide some basic personal information, like your name, address, date of birth, and your social security number. You'll also need to link your regular bank account so you can transfer money in. Don't be intimidated by the application. It's very straightforward, and millions of people do it every year. Step 3 is where it all comes together. It's time to set up your first automated investment. Once your new brokerage account is open and you've transferred your first bit of money into it, it can be as little as $50 or $100. Here is what you will do. You will log in. You will use the search bar to look up the ticker symbol of the index fund you chose from our strategy. For example, you'll type in VTI or VOO. The fund will pop up. You'll click the Buy or Trade button. Then, you will look for the option that says Set up a recurring investment or automatic investment. This is the most important part. You will tell it what you want to do. For example, I want to invest $100 from my linked bank account into VTI on the first of every month. You confirm the details. You click Submit, and that's it. You've done it. You have officially become an investor. You now have a simple, powerful, and automated system working to build your future wealth. Now for the final, crucial part of our discussion. You've started your journey. Your automatic investments are happening. But a few months or a year down the road, it's going to happen. You will wake up one day, turn on the news, and the headlines will be screaming, "Market plummets," or "Stocks enter bear market." You'll log into your account, and you will see the value is down 10%, maybe 20%, maybe even more. It will be a sea of red. Your heart will pound. Your stomach will lurch. Your first powerful, primal instinct will be to panic. A voice in your head will scream, "Sell. Sell it all now to stop the bleeding before it goes to zero." This exact moment is the single biggest test you will face as an investor. And making the wrong move here is how most people truly lose money. When this day comes, I want you to do one thing before you do anything else. Zoom out. I want you to ignore the daily or weekly chart and find a chart of the S&P 500 that goes back 50 years or more. You will see a line that, over the long term, goes sharply up and to the right. But along that line, you will see several terrifying, jagged drops. Look closely. You'll see the crash of 1987. You'll see the dot-com bubble bursting in 2000. You'll see the great financial crisis of 2008. You'll see the sudden, sharp pandemic crash of 2020. Each one of these events felt like the end of the world at the time. The news was filled with doom and gloom. But what happened after every single one of them? The market, without fail, eventually recovered and went on to climb to brand new all-time highs. History shows us, time and time again, that for long-term, diversified investors, these market downturns are not permanent disasters. They are temporary sales. They are opportunities. The biggest mistake is to treat a temporary sale like a permanent loss by selling at the bottom. So what is your job during a market panic? Your mantra should be, don't just do something. Stand there. Your job is to do absolutely nothing. Do not sell. In fact, it's best if you don't even check your portfolio every day. Maybe check it once a month, or even once a quarter. Just let your automated plan do its job. Remind yourself that your dollar-cost averaging strategy is hard at work. While everyone else is panicking, your plan is calmly buying up more shares of your great index fund at these new, cheaper prices. The fear and panic of others is creating a discount for you. The people who truly lose money in the stock market are the ones who buy high out of greed and sell low out of fear. You're automated. A motion-free strategy is designed to do the exact opposite. So, let's bring it all home. We've walked through the entire journey together. We've looked fear directly in the eye, and we've built a plan to overcome it. Let's recap your new toolkit. We learned that the real, silent risk to your future isn't a volatile market. It's the slow, steady erosion of your money's value due to inflation. We learned that compound interest is your personal superpower for building real wealth over time. We learned that diversification through low-cost, broad market index funds is your shield, protecting you from the risk of any single company failing. And we learned that dollar-cost averaging is your simple, automated strategy for taking emotion out of the equation and turning market downturns into opportunities. You now have all the knowledge and all the tools you need to get started. Becoming a successful long-term investor is not about being a financial genius. It's not about being a daredevil risk-taker. It is about two things: patience and consistency. It's about making a simple, sound plan and having the discipline to stick with it through good times and bad. You can absolutely do this. The journey of 1,000 miles begins with a single step. Your journey to financial security is no different. Maybe your first step after watching this video is simply to go to one of those brokerage websites and look around. Maybe your step is to open that Roth IRA account. Or maybe it's setting up your very first automatic investment. Even if it's just for $25, that first small step is the most important one. So I want to ask you, what is the biggest fear that is still holding you back? Let me know in the comments section below. There is an entire community of people who feel or have felt the exact same way, and we can talk about it together. If this video helped clear away some of that fog and fear for you, please consider giving it a like and subscribing for more straightforward, no-nonsense financial guidance. Thank you so much for investing your valuable time with me today. Your financial future is waiting for you to take that first step.